Good afternoon, everyone. Thank you for joining today our sixth Investor Circle webinar session. We're waiting for another minute for more attendees to join, and then we kick off shortly. Yeah? Perfect. Also, maybe in the meantime, we can start with the soft introduction, maybe starting with you, Philipp, and then with Julius, also since you're part of W3 Group, very known in Germany. Maybe you can give like a slight introduction while we're waiting for the other attendees.
Sure, happy to do that. We have an introduction also in the talk that we will have, but I can already start giving a broad overview. So I'm Philipp. I'm one of the partners of W3 Wave. W3 Wave is a liquid token fund, which is part of the W3 Group ecosystem. So the W3 Group is a Berlin-based, or the biggest German W3 platform based in Berlin. A little bit similar to what TheBlock is in the UAE. We're essentially building a hub for W3 Web3 ecosystem out of Germany. So we have a big co-working space where we host many entrepreneurs and individuals, as well as big companies and very known Web3 protocols who work out of our physical space. We host many events. We have a venture fund where we do early stage venture investments purely in the Web3 space. And then we also have the liquid token fund, which we will be talking about today. And then we also have an infrastructure business with which we support family offices and high net worth individuals when it comes to staking in a compliant and professional way. Maybe a few words about myself. So I started my career in the Web2 world. I was actually at Google for almost 7 years. Where I led hardware marketing as well as B2B enterprise marketing. In 2016, I found my way into crypto through luck or coincidence. I attended one of the first Ethereum meetups in London, and I was very fascinated by the technology, especially working at Google in the Web2 space. For me, it was very clear we need new technological building blocks that tackle the big questions around data privacy, data ownership. And I think today in the world of AI, these questions are even more prominent and important and need solutions. And back then, for me, blockchain was one of the solutions for that. But as we will go into later as well, blockchain is a lot more than just one thing. It means many different things. And one of the things is, of course, investing. And so in 2016-17, I started my career investing in the space, primarily venture investing, and throughout the years, obviously this turned more into liquid investments, as a lot of venture investments eventually will launch a token. And in 2022, I met Julius, and we decided to launch W3 Wave, the liquid token fund, together.
A really amazing journey, and glad you found your way from Web2 also into Web3, and also with the establishment with the fund as well. And super excited to also hear from you, Julius, your story, your role also in the fund, and over to you.
Yeah, thanks for the kind introduction and for having us today, Sarah. So I was also I would say lucky enough to have studied economics in like 2012, 2013, and sort of through that found my way into the crypto space. Well, back then it was only Bitcoin, and then was also lucky enough to meet the Ethereum team very early on in 2014, and sort of through that started investing obviously in the space, and then being invested, also started following the developments. And obviously today we're at a scale and at a adoption level that I could have not sort of foreseen back then, but I'm happy that it happened that way. After university, I spent a few years with McKinsey as a consultant, and then transitioned into venture capital. Also sort of there, did some crypto venture investments, and similar to Philipp, over the years, sort of moved a little bit away from the venture side, and started getting more and more excited about sort of the liquid side of the market, which we're going to talk about today, what that even means. And yeah, just through the experience of managing, a personal portfolio, many positions, and seeing the space evolve over the years, we really like the idea of setting up a liquid token fund ourselves. And yeah, pursued that for almost 2 years. It took quite some time to find the right setup. We wanted it to be in Germany with sort of all regulations in place. And they finally managed to launch the fund last year, and are very excited about the direction that this space is currently taking. We think that we're at an inflection point, and there's a lot more interesting investment opportunities to come in the upcoming years.
No, super. No, definitely agree on that. I mean, we saw, especially in the past years, there have been a change also in the crypto VC landscape, right? Moving from direct investments into investing in secondary market. And I think also the next one hour will be the core scope to dive deeper, to understand more about it. And before we dive in, just to inform the audience, if you have any questions, on the right-hand side on the top, you see a little question mark, and if you click on it, you're able to post all your questions that we can take up at the end of the session. Just to walk you through today's agenda, we will start just with a quick brief also about the Investor Circle for the ones who haven't been a part yet, or who want to learn also about the block and the investor ecosystem. Then we kick off with the deep dive from both of you, and then followed by a fireside chat. So I would say let's deep dive right in. So let's start. What is actually the block and also the Investor Circle? So for the ones who don't know yet about the block, it's the Chamber of Virtual Asset in the UAE, and supports really different stakeholders in the process, if it comes to startups, if it comes to corporates, investors, or regulators as well. And we really support hands-on startups from inception up to licensing, activation, visibility, for instance, for media support, until successfully fundraising as well. We have different programs, again, for different profiles. For instance, for founders and startups who want to set a footprint in the Middle East, the block is closely linked and in the same mandate like Dubai World Trade Center and Bara, and supporting heavily when it comes to different type of business setups. Especially now we're focusing heavily also on real world assets and everything around tokenization, and also for capital providers such as VCs, family offices, and angel investors. We offer different initiatives such as educational webinars that we're doing right now, but also funding opportunities, as well as exclusive initiatives in the future. What is currently on at the block is the next milestone will be the opening of the physical spaces in Dubai. So for some of you who are aware, with Dubai, the Experience Center will be opening in One Central, which is a prime location where also other crypto and Web3 firms are located. This is expected to be open also end of October. The same goes also for the Block Tower, which will be located in World Trade Center itself, and offers different type of facilities such as meeting rooms, work desk, podcast studios. So this is something that's coming up next at the block. As I said, for the Investor Circle, the initiatives that we're doing right now for educational purposes, also bringing more spotlight on high scalable startups in the ecosystem as well. Currently, we're focusing heavily on RWAs, but also when it comes to any support such as advisory consulting, we are there in the Investor Circle to assist as well. And with that, with further ado, I would like actually to move over to Julius and Philipp, and to get deeper into the area of crypto liquid funds. So over to you.
Awesome. Yeah, so as mentioned during the introduction, we'll focus our talk today around sort of the topic of liquid tokens, what that even means, how that is different from sort of the traditional venture model, and then also going through some examples and basically ending with what sort of liquid tokens enable us to do, but also generalize what types of investment strategies are enabled by sort of liquid markets in crypto. We did have some introductory slides on our team, but I think we already went through that. So I would hand it over to Philipp right away to kick us off for the first half of the presentation.
Okay, great. Thanks, Julius. So yeah, let's start maybe with the motivation for this talk and what we want to cover here. So throughout the years that we've spent in the industry, we noticed that even professional investors often struggle to really separate the signal from the noise and have a hard time identifying where the real lasting opportunities really are. And so one of the issues we think is that in general, a lot of the things that happen in the industry get lumped into one bucket. So we have Bitcoin, Ethereum, layer 1s, layer 2s, even layer 3s. We have meme coins. And often all of these things are treated the same way. But the reality really is that blockchain is a technology, and the token on top of that are incredibly diverse, and it's just an incredibly diverse market. So we have thousands of tokens across infrastructure, so the base layer, decentralized finance, real-world assets, even AI is a topic that's really merging now with crypto. And a lot of these projects, and of course the token on top of them, have very different characteristics. So this spans from different technologies that are being used to also different business models. Yes, many crypto projects actually have business models, and understanding these business models is really key to navigating the market. So things are changing fast, and so really staying on top of that and understanding is key. And what's really needed is having the right tools to navigate and understand the market. And we see that investors often sort of end up chasing hype and missing the real opportunities just because they lack the right tool, the right frameworks to really look at the market, differentiate between these. So what we hope to do with this talk is really give an insight into what are liquid markets, and also talk about some frameworks that we use to navigate the markets, but also the risk management we use, because that's obviously very important in the market that is highly volatile. So to start, perhaps we can move to the next slide. I wanted to zoom out a little bit and sort of lay the foundation of what we're talking about here today. So first of all, in terms of market structure, crypto is a $4 trillion market, so it has grown immensely. That said, if you look at some of the market caps of some mega caps like Nvidia, crypto is still smaller than a single mega cap, right? So we've come a long way, but there's immense opportunities to grow here and grow. But this growth often comes with volatility. So crypto markets tend to be very volatile and very cyclical in nature. That said, we do see markets maturing. So volatility is starting to decrease. We tend to still see the 4-year sort of cycles. We'll come to that a little bit later. But overall, we see more maturity, and a lot of that comes from regulation. So especially this year, end of last year, this year, we've seen a lot of regulatory things come our way. So we've seen in the EU, particularly the MiCA framework last year, which was introduced last year, which really gives a lot of certainty and foundations for protocols, but also investors to navigate those markets. And then this year in the US, we also got the Genius Act, which is basically a standard for stable coins. We have ETFs, we have ETPs, and also very importantly, we have regulated custodians. So these allow institutional investors to really on-ramp into crypto and also custody crypto assets in a compliant way. And these are sort of the the building blocks and the rails that are needed for this asset class to become more and more mature. And we've seen this accelerate a lot this year. And eventually this has really led to institutional adoption. Institutions are here. I think you might have all seen treasury companies such as Strategy, MicroStrategy, but many more treasury companies coming out now. I think I looked yesterday, we have a total of 176 listed companies who hold more than $80 billion worth of Bitcoin on their balance sheets. We have spot ETFs for Bitcoin, ETH, Solana likely coming very soon. And I think a recent survey that I saw said 60% of institutions plan to allocate 5% or more of digital assets to their balance sheet. So the momentum is here. Institutional adoption is already here. And so this is certainly a market that everyone should take seriously and try to understand. Let's maybe move to the next slide. So one more important thing to understand about crypto, that it generally doesn't move in a straight line. It's a market that's really defined by volatility and cycles. So annualized volatility sits between 60 and 100%, which is a lot higher than equities or foreign exchange. And that might sound like a drawback, but actually we really see this as something that makes this asset class so attractive and really allows for these outside returns that are still possible in crypto. We also have a cyclical nature, so this is certainly not random. So crypto is cyclical in design, and it's generally driven by cycles of innovation, but also by global liquidity and business cycles that we have, particularly since the financial crisis 2008. We are seeing a fairly regular four-wave business cycle pattern, and this is often also reflected in the crypto charts, as you can see here on the image. I also wanted to show this image to kind of share where we believe we are currently in this cycle. So you can see the four major cycles on this chart, and you can see that we are a little bit more, or very likely a little bit more than halfway through the current cycle. Of course, it's very hard to predict where we will go, but we believe we are still very much in this cyclical nature, and likely will have another cycle that plays out within the 4-year cycle pattern. If we move to the next slide, we want to get a little bit more into the core of this talk today. And the context here is that crypto generally really, or crypto is the first time we can really blur the line between venture and public markets. So in venture capital, you normally wait 8 to 12 years for an exit, whether that's an IPO or an acquisition, before you really see liquidity. In crypto, the same process is a lot more compressed. So usually we see liquidity events happening within a few months or to a few years, so a lot faster. And that just creates a very different environment, which has pros and cons. So on the upside, you get, as an investor or as a founder, you get a lot faster liquidity. You have tokens that you can actually use to incentivize your users or other participants in the ecosystem. So incentives in general are an important part of crypto, and why many protocols are able to grow so fast. And you have as an investor, you have an ability to rebalance your portfolio more dynamically. So rather than holding a venture portfolio for 10 years, I can, based on certain data points, decide throughout this life cycle whether I want to dial up or dial down that position or rebalance my portfolio. On the downside, of course, one has to deal with a lot more volatility, a lot shorter investment horizons, and also sometimes misalignment between insiders. So yes, often there are investors that will try to get out of positions very early. And that's just something that should be closely monitored. It's something we actually look at very closely to understand whenever we invest in a project, who are the venture capital firms that are in there, who are the major holders, and how likely are they to continue to believe in the project and hold the token. So I wanted to illustrate here a little bit how we're blurring the lines between venture and public markets. And now Julius will dive a little bit more into concrete examples and what this actually means for investing in this space.
Awesome, thank you. So to make this a little more hands-on, we brought here two examples of where we want to show you how this early liquidity changes sort of the investment possibilities with regards to projects which we still mostly consider startups in the blockchain ecosystem. So the first one here, it's called Pendle. It's a DeFi protocol. And if we go through their timeline, so you have the regular initiation, founding story, a team comes together, has an idea, and they build their product in 2020, 2021. They even go on to raise a private fundraising round with venture capitals. But then only shortly after, they do what's very common in the crypto space, to do a public fundraising. So that means basically, retail investors and generally anyone who wants to can invest in the token at a certain valuation with certain terms associated with it. Shortly after, they had their what's called token generation event. So the token went live, and as you can see on the price chart that we have here, there was like an initial hype around the project, but then the token also sold off heavily. And this is not uncommon that we see sort of around these liquidity events. There's usually some amount of hype, and then sort of investors or participants fail to continue this hype or have an idea what the token should be worth, and then usually you see also some sort of sell-off. And this is also where we see a lot of opportunity, because what this team then did is they continued to build. So they used the sort of bear market of 2022, 2023 to pivot their whole product and direction. They did a investor token sale in 2023. So basically the protocol still had tokens on their balance sheet, which they sold to investors, and found product market fit in 2024. And we've seen tremendous product market fit, but also tremendous appreciation of the token. And I think this is a really interesting example, because it basically shows you what this early liquidity gives you. It gives you lots of volatility. So just look at the price chart. Basically, imagine your startup that sort of goes through these iterations, and the sort of the valuation is publicly listed and traded on a day-to-day basis. But it also allows someone like us, who sort of is a professional investor in this space, to talk to these teams and identify the ones that keep building throughout sort of the difficult times also, and continue to iterate and then build up position, which we then can manage in a liquid market. A second example is Hyperliquid. That's a more recent one, protocol which currently has a lot of hype. I mean, I think the key differentiation here is that they did not go the traditional route of raising venture capital, but they kind of bootstrapped their protocol themselves. And so what they did, they built a product, they bootstrapped it, and they had users use the product in 2023 and 2024, prior to launching their token at the end of 2024. And what that means is that any institutional investor, be it liquid fund like us, or also some venture funds and crypto hedge funds, who wants to have exposure to such a project, needs to buy on the open market. And you can see that on the price chart, from the get-go, basically it had a big rally, and that was literally big funds building up their positions. And so I think this is also an interesting example. Something that we see more often in recent years is that projects do not necessarily go the traditional venture route, but basically build out in the open, and then launch their token. And sort of if institutional investors are interested, they need to buy the token on the market. So I think those two examples really show how different it is in terms of like the life cycle of a crypto company compared to traditional venture, but also what type of investment opportunities it offers. As you saw on the two charts that I just showed, they're quite volatile. And I think this is a characteristic that we see in the crypto markets in general. So the question that comes to one's mind is obviously, what drives the token price? What are value drivers? And one could assume that as those are all startups and like early stage companies, their valuation should be pretty much focused around sort of their traction, let's say their growth, or how many users they onboard, how much revenue they're doing, and so on. But that's not really the case, because their token, which determines their valuation, is traded on the public market, which is influenced by a variety of factors. So I want to go through just a couple, just to give you a sense of sort of what you or we as investors in the liquid markets need to have in the back of our minds when thinking about sort of fair value of a token. So first off, macro, obviously, I mean, we don't have to look back too far. If you remember the sort of the Donald Trump tariff announcements earlier this year, or other geopolitical events this year, which heavily influenced markets and also heavily influenced crypto markets. And so those things tend to create a lot of volatility in the markets, despite them necessarily not having an impact on the individual projects that we invest in. Other things are such benchmarks. So for example, if I launch a token for a certain project and there's already competitors in the market with a token, my valuation will often be in relation to sort of what the benchmark is valued at, and not necessarily only my fundamentals. There's strong narratives in crypto markets. So what we tend to see is that there's a very strong momentum in crypto markets. So if something tends to gain momentum and sort of has a strong narrative as tailwind, then basically that tends to push prices. So if you remember NFTs in 2021, for example, or metaverse was a big narrative which really pushed prices and was not necessarily correlated to fundamentals. Speaking of fundamentals, this is obviously something that we track quite a lot. So where we spend a lot of our time thinking about, okay, what is the right valuation model for a certain protocol, and what are the data points that we need to track in order to determine what a protocol could be worth. We tend to see a trend where fundamentals are becoming more and more important, and we hope that sort of we 3 to 5 years down the road, we live in a world where a lot of crypto protocols trade more on fundamentals than on pure narratives. And finally, investor sentiment. So obviously, investor sentiment in crypto through volatility is very strong and is a driver that reaches both ends of the pendulum, so fear and greed, and that's reflected in these very volatile spikes to the upside, but also to the downside. Now, one could say that's a bad thing, but we also think that's an opportunity because through our fundamentals of valuation framework, we tend to know or have an idea when things are overvalued and undervalued and try to trade on the upper side of that. So in general, this liquidity offers a variety of investment opportunities in the crypto markets. So obviously there's venture capital, which can have very high returns, but also is generally low liquidity, even though sort of in crypto that time to liquidity is shortened a little bit also for venture funds. We have all kinds of hedge fund strategies where it really depends on what they're doing, but in generally is a little bit lower return, but also liquid. You have yield strategies, and then what we sort of the area that we play in, which we term liquid venture. And liquid venture basically means that we plan to invest in these projects with sort of a high return expectation, similar to what a venture fund wants to return, but we only hold liquid tokens on our balance sheet, so that allows us to realize those gains in a shorter period of time, or also then sort of go out of investments if we think they don't develop in the right way. And now you might be asking yourself, okay, how do you select sort of investments in this new liquid crypto world? And we really believe that it's the best of both worlds. So our due diligence process is very much similar to that of a typical venture fund, where we talk to the team, to other investors, we look at the market size opportunity, we test the product, we look at sort of their growth metrics, but also their tech, what they've built, and really try to understand basically, okay, what's the protocol, the company, and sort of stakeholders surrounding the token. But then we have this additional layer of data points that we can utilize, which is more akin to public markets investing, where sort of we can look at price history, look at token trading volume data, what Philipp mentioned earlier. We can look at the holder base, so who's holding this token, and try to understand sort of if there's a lot of money flowing in or flowing out of the ecosystem. We can look at the traction, and the good thing is that most of these projects are obviously building on the blockchain, so the data is publicly available, and really it's best of both worlds. So in the end, what we do is we go through hundreds of different tokens and protocols and try to understand where we see opportunity in the market and where we can form a strong thesis around a growth for a certain project, which then ultimately also results in a appreciation of token price. And finally, sort of running a liquid crypto strategy requires also a unique operations and risk management. So, you know, with venture investments, it's pretty straightforward. Usually, you know, you hold equity investments, and then at some point maybe you receive some tokens. But for us, sort of as we are invested in the market, and the markets are volatile, and sort of there's certain things that are happening, we need very active monitoring of our portfolio at all times. We need to have liquidity management when it comes to building up positions or divesting positions. Obviously, we do not want to have a big price impact on the token chart when we trade our positions. So those are all things that we need to take into consideration, and that also is reflected on the portfolio. So portfolio rebalancing, determining the correct weight for certain positions in our portfolio are all things that we manage on a day-to-day basis. And on the operational setup, obviously security is at the top of our mind. You know, you hear all these stories around sort of security incidents and hacks in the crypto world, and obviously that's the last thing that you want as a professional investor in this space. So having the right setup, having the right custody, for example, we have a custody provider that's from Germany and has all the licenses that they can in our jurisdiction. That's something very important to us. And lastly, also in terms of access or determining what are the right trading venues where I need to be onboarded in order to buy or sell the tokens that I want to trade. That also means having the right OTC relationships, and generally having a professional, you know, trading setup that allows you to get best execution for your positions. So that is basically the last slide. We wanted to give you an introduction today, what it means to have liquidity in sort of startups, if you want, in venture markets. Crypto is very unique in that sense, where investors can gain exposure to certain projects via holding liquid tokens. So if we do that and build positions, build a portfolio of different tokens that we want to hold, a lot of other funds are doing it. It's an area where we believe it still has strong growth ahead of it, but it also comes with sort of certain challenges, such as, you know, being influenced by macro developments, or you as a investor having need to worry about sort of liquidity operational setups that a venture investor maybe does not have to worry so much about. Yeah, we look forward to your questions and the fireside chat with Sarah.
Yeah, thanks a lot, Julius and Philipp, to bringing more light to the crypto liquid funds. Even from our InvestorCircle, there have been increased demand. What is behind crypto liquid funds? As mentioned also before, there has been a shift that more crypto VCs are moving liquid, and there's a valid point you mentioned when it comes to the selection of tokens, right? It's more critical to have quality over quantity, and there's also now from recent reports that a lot of liquid funds are moving away from low quality or speculative tokens towards quality tokens with stronger fundamentals. And I would like to learn how has the shift affected W3Wave, especially when you select tokens, and can you share examples where you pass on popular tokens in favor of the ones that you saw more robust? So how is that decision process are playing out for you when it comes to tokens?
Yeah, it's a really good question. So we definitely see a shift as part of the maturing market. So throughout the cycles and even within the cycle. So earlier this cycle or end of last cycle, with also the rise of Solana, we've had a real explosion of tokens. I couldn't tell you how many tokens there are, many thousands. And so, yeah, it's just really, really important to have a good framework to filter down the funnel essentially, and figure out which, if these tokens are investable and which suit one's investment strategy. And as Julius has shown, there's many different type of funds out there, and I would say almost all funds have probably a very unique way of investing, and one needs to find their own edge in investing in the market. In general, I would say that today investors are a lot more sophisticated and institutionalized. So I think we are seeing a shift more towards fundamentals. being the real reason for demand versus, let's say, pure speculation. But that side of the market is also always going to exist. But I would say in general, that's more of a retail focused market where institutions are certainly looking a bit more at, or definitely looking more at fundamentals. So for us, this really means looking at tokens in a lot of detail and understanding where the demand and flows come from. So this can be from external capital. So like Bitcoin, Ethereum, we now have ETFs. ETF inflows. We have corporate treasuries buying up these assets on their balance sheet. So this is an interesting sort of demand and flow that we are observing, which is fundamental. And then on the protocol side, we're also seeing real revenues, real fees generated, and with more regulatory clarity, those fees also being passed on to token holders. So we can see real value accrual on the token level. These are the kind of things that we like to look out for. For us, to give you a specific example, so we tend to focus on fundamentals, right? We actually want to see projects that have business models that are starting to see traction and product market fit. So yes, while we are excited about visions of protocols and founders, specifically right now in the area of AI and AI agents, there's a lot of stuff happening. We talk to founders almost on a weekly basis. We get very excited about some of these ideas, but one has to keep in mind that these are often future visions, probably more suitable to actual venture than tokens. But there is also a time within crypto or the cycle where these things can be interesting. So we're not ruling out investing in narratives, but we tend to focus on the fundamentals. And yes, we've passed on a lot of, let's say, exciting AI narratives for more fundamental, let's say, decentralized finance or stablecoin projects, which we have invested in the recent months.
Indeed, I think we've seen also often, especially when institution wants to come in or traditional investors, for them it's also more crucial to have the stability. Is it through the project itself for regulatory clarity, as you mentioned, and having really robust tech and protocols behind it. And it's interesting, they've been, I mean, big players like Pantera and Coin Fund, they also kicked off with liquid funds, and they mentioned also that their smart token selection outperformed their fund rather than having specific trading strategies. Of course, every fund set up their own strategies, market neutral, algorithmic. And how is it in your view when it comes to driving your returns? Is it more, again, the asset allocation, the token choice that we just discussed? Or do you still pay also attention in terms of timing, market structure, the strategy? Because especially Julius, you presented also earlier, there are different factors, right, playing a role. So
yeah,
how do you do that?
And I think this is an interesting point, because I think also sort of, you know, I showed this slide where sort of we have venture, you have hedge fund, you have liquid venture and so on. But even within those buckets, there's many different strategies. And so first, to answer your question, yes, I would say definitely asset selection has been a core return driver. And funny enough, this was part of our core thesis going back to 2022, early 2023, when we started talking about the fund, is that we said, look, this time of sort of retail driven mania that we saw in 2017 and 2021 is, we don't think that that'll repeat again necessarily, but that actually we'll see a more dispersion of returns in crypto markets. Also, just because there's so many tokens, and most of them, quite frankly, don't have any right to be there, because there's not a lot backing them, right? It doesn't mean that the industry is bad, just means that people tried different things in sort of the past 10 years, and a lot of those experiments didn't work out. Okay. And so we initially started with saying, okay, we need to focus on things that have strong fundamentals, but also have strong momentum drivers, because I think those two factors tend to determine token price in the short term: momentum and sort of fundamentals. And I would definitely say that's a big driver. And on the question of sort of market timing, I think it just comes down to the strategy of the fund. So I know many liquid funds have a mandate from their investors to sort of not manage the market exposure. So that means always be basically 100% invested. We choose for our investment strategy to also manage the exposure for our investors to the market. And so that means that we do at times raise cash or cash equivalents on our balance sheet in order to sort of realize gains, and then ideally find good entries again at sort of lower prices, or just to de-risk a position around sort of a time of volatility and kind of where we want to sit out a little bit. And so yes, for us, both of these, but I would say the bigger driver of returns is definitely like the asset selection. There's very few big winners of the past 2 years. And if you sit in those tokens, Hyperliquid is one that I showed, it's a big winner. If you have those on your balance sheet, then you generally did well. I think, yeah, this is the core challenge for liquid funds like us at the time, sort of selecting the right tokens.
Super. No, yeah, it's at the end, it's really considering different aspects as well. So it's a valid point. Also, again, for our audience, in terms of questions, if you want to post a question on the right side, on the right side on the top toolbar, you see a speech bubble. So there you can write all your questions, also to Julius, to Philipp, that we can answer in a bit for our Q&A. Coming to the part what you said, especially being prepared for risk and downturns, right? As we say, there are macroeconomic events, if it comes to flash crashes, or how does your fund actually is prepared for it, and how do they position themselves in such situation?
Yeah, maybe first off, we think about liquidity on sort of two levels. So I think there's the macro liquidity, so the overall market liquidity, which is influenced by macro conditions, and that really drives in the end risk assets and crypto markets. And these are partially predictable, partially not. So of course, you know, we follow very closely the US economy, what the Fed does, but also China and global liquidity overall. So that's one important factor when we look at liquidity. And then, of course, specifically on the token level, how deep is a token, and how deep is the liquidity? And so sometimes a token can look very attractive, but if there's no liquidity and there's no trading venues, then yes, liquidity can dry up very quickly. So for us, when we think about investing in tokens, looking at the liquidity, understanding where these tokens traded, how does the liquidity evolve over time, is really, really important so that we can manage the execution risk of a particular trade. Now, I think your question was also hinting more towards something like black swan events, and how we deal with that. So I think, first of all, we don't take leverage in our positions. We do primarily trade spot. We can trade futures without leverage, just for hedging, but we don't use leverage. So we generally, don't like to add additional leverage or liquidity risk into our books. And when it comes to sort of black swan events, well, per definition, they are not really predictable, but often in crypto, they actually present great opportunities for entry. So for us, it's really important to, in general, maintain stablecoin buffers, so that we can actually buy into the market opportunistically. But also, there are sometimes ways to anticipate these things. So when the whole Iran-Israel topic occurred earlier this summer, we actually saw the oil price spiking significantly 3 days in advance, and we decided to risk off, and then also used the drawdown that we saw in the markets as an opportunity to build up a position again. So I think one just has to be very smart, monitor very closely the market, and I think another reason why doing this full time is really very much needed if you want to outperform and perform in that market.
No, thank you. No, that's a very essential point. And there would be a next question, and I included actually with a question that has been asked also from the audience when it comes to the role of derivatives and spot exposure, like many liquid funds combining spot trading with derivatives, right? And just to enhance also the returns, manage the risk. What is your fund stance on using derivatives, leverage, short, market neutral position, and how do you balance the complexity with the versus the transparency and risk?
Yeah, I think it comes down to where you also see your edge in the market. I know very few traders that sort of that are top of their class in sort of spots. So directional long, long short, or just outright short. For us, we see our main mandate to be a directional long in sort of fundamentally strong tokens. And we actually just recently changed our investment guidelines where we can also have derivatives exposure. As Philipp mentioned, we do not use this or do not plan to use this with leverage. It's more for us a sort of instrument that we can use. So let's say you want to de-risk a little bit. You can either sell spot or you can just hedge your position via a short, which gives you some more flexibility. Usually there's also a negative a positive funding rate in crypto markets, sort of which pays you if you go short. So that could even be some yield, even though we would only use this more tactical. What we don't plan to do is just like go outright short the whole market, because sort of if you look at the liquid fund ecosystem, there's a lot of fluctuation. So a lot of people manage to blow up, and I would say a significant portion of that is due to leverage and sort of trying to expose a view on the market that is hard to risk manage.
No, that's completely true. Especially, how is it for you when it comes to turbulent times, and especially when it comes to communicating towards your investor, right? Like, what governance practices do you have in place to report to the investors, and especially when it comes to unexpected portfolio outcomes or challenges? Like, how do you navigate that?
So we obviously try to, I mean, it's in the end, sort of you try to build trust, and I think and be transparent and open, and I think you can do that through various ways. So for us, first of all, it was very important to find a fund setup that's regulated in Germany. We did not want to go offshore. We wanted to sort of show that it's possible to do it here, where we have pretty good set of regulations. That comes sort of with more work on our end to talk to the regulator and so on. But I think for investors, it definitely builds trust. And on top of that, we report on a monthly basis. So basically, I think investors get a monthly NAV report, where they know where they stand, and further we add to that a monthly market comment that we write, usually somewhere between 5 to 10 pages, where we share our view on the market. That includes macro outlook, that includes sort of more crypto native outlook, and also portfolio positioning if there are any core changes or core positions that we are excited about that we want to share. What we don't have is like a real-time portfolio, and we also never really had the demand for that from our investors. But I also know that sort of in this area, there's different funds do it in different ways. This is our way to build trust. And because you mentioned turbulence, so we actually communicated quite a bit in Q1 and early Q2 around sort of the very volatile markets in February, March, and then early April around the tariff announcements, and try to sort of communicate very clearly how we positioned and how we view the situation. But yeah, I think in the end also when it comes to this, it really pays off. So both Philipp and myself, we've been in this market for so many years that it's like we've seen so much volatility and sort of crazy events happening in the crypto markets that we've personally become a little bit numb to it. And I don't mean that in a bad way, but I think there's just a lot of noise if you really focus on all these like day-to-day volatility and things happening. There's a lot of noise, and the question is always, do you want to focus on that, or do you want to sort of focus on the directional the direction where the market is going? And the market is clearly growing. We're seeing tremendous adoption. So sometimes I think it's also the best to kind of not necessarily comment on every little thing to your investors, because it just, people will just go crazy.
No, super. And then actually it's a right time to move to the next question in terms of future outlook. How do you see the crypto liquid fund landscape evolving in the next year, even globally? Do you see there also a shift coming? We will see more diverse crypto liquid funds. Like, how is your outlook for the next years on that?
Yeah, good question. So overall, we still see liquid funds quite underrepresented compared to venture. So we believe venture is fairly bloated. There's a lot of capital finding its way into venture, even though the liquidity in token is growing rapidly. So I think one of the big unlocks of all of this is regulatory frameworks. That we see improvement, especially around token accrual or token value accrual mechanisms that I mentioned earlier, becoming more robust. And we also see TradFi and hedge funds actually starting to now enter the space. So I did see a survey, and I think the share of traditional hedge funds investing in crypto is up to just over 50% this year. I think last year was around 30. So yeah, this is getting a lot of attention. More and more sophisticated players are entering the space. We think as a crypto native liquid fund, we still have a certain advantage, particularly around our network that we have and the deep relationships which we have with protocols and founders. But yeah, we see a lot more attention now in the liquid markets. We also see an appetite from investors to invest without the long lockups. So this is one of the big USPs where we saw success in fundraising, or see continued success since we're an open-ended fund. And yeah, we believe that more and more eyes will be on liquid venture, with both crypto native players, but especially TradFi hedge funds starting to enter the space and playing alongside of us.
Yeah, indeed. I think this year has been a heavy institutional one for crypto, as in terms of inflows, also regulatory clarity. Big players are moving in. So no, super to hear there also your outlook. And now moving on to the question from the audience. Let me jump right in. We have a few questions. One is related, what's the AUM as of the last NAV date, and year-to-date performance has been one question.
So our AUM right now is around 10 million euros. So we are an open-ended fund, as mentioned. So we have investor intakes on a monthly basis, and we serve investor redemptions on a quarterly basis after an initial 12-month lockup. This is how we have structured the fund. With regards to performance, it always depends on the cohorts that you're looking at. Since we're an open-ended fund, it depends what month investors have joined. If you're asking, I think specifically the question was year to date. We are actually just below break even year to date. So this is from January, and the reason here is because we had a fairly strong Q4 with a larger drawdown, I think just around the 31st. So the January cohort is actually one of our worst performing ones. But yeah, if you're interested in more detailed performance, I'm happy to set up a separate call, and would love to share that with you.
Super. And then the upcoming question was, imagine there's another huge dip of over 40% coming in Q2 26, or even a bear market. What is your strategy and positioning?
Julius, that's a very, very, very concrete scenario. So let me try to generalize a little bit more. So I think the market structure has shifted in crypto. I think I mentioned before that so far as we see the past 2.5 years, especially ever since we got the ETFs. It's more dependent on sort of large in and out flows of more institutional investors, and not so much by institutional by retail driven sort of hype cycles. Obviously you get these every now and then in some pockets of the market, but it's not as broad as in the past years or past cycles. So that goes to the question, okay, is there another like huge bear market, 2 years where no one wants to invest in this market? And yeah, maybe we see that. I think it depends on where you're investing. I think it's less likely to see it for Bitcoin. It's more likely to see it sort of in the long tail of assets. And so I think it's a fair question, because we obviously tend to invest also in the long tail of assets. And so whenever I think we want to go risk off, the question is now, how do we position prior to a drop if we can anticipate it correctly? So let me answer that first, and then we go to the other scenario, what we do after a 40% drop. So if we think that the market looks sort of exhausted, or sort of there's been too much speculation, open interest for derivatives is going through the roof, we tend to go risk off, and that for us means stable coins and or Bitcoin on our balance sheet. And sort of with stable coins, we can do a lot of things on the yield the yield market. So obviously at least try to get some returns there. And sort of what we do after a big drop, I'd say it's very hard to answer, because it really depends. So for us, I think what we saw this year in April and May, I think it really was a big opportunity to go back into the market. But I think there's also times where sort of you see a structural shift, maybe also macro driven, and that will be reflected in sort of equity markets and or the bond market, where we say, okay, we might have dropped 40% with the market, but we don't think that sort of it's a V-shaped recovery, and there's maybe a prolonged period of exhaustion. And I think in that case, we would be a little more hesitant to go necessarily back in the market, or maybe we test the waters a little bit, build up one or two smaller positions. And generally, we dollar cost average our position, so it's not like we click buy and then we are fully exposed or out of the market. And then if we get the sense that sort of when it's not moving in the right direction, there's no momentum returning to the market, again, momentum's the most important factor in crypto, then we would stay sidelined for a prolonged period of time until sort of we see some real exhaustion and sort of trend reversal.
No, super. No, thank you, Julius. I think overall we can see, even with crypto liquid funds, right? Each fund has their own strategy, their own way to navigate also risks. And I think this is also, that's why it's important also having this session for also here in the audience, for the investor who are interested to tap into it, to know the fundamentals, the core, because there are so many elements that play a role in macroeconomic, of course, but also the structure of funds itself. And now we're coming slowly to the end of our session. And thanks also everyone joining, also Philipp and Julius, thank you for your insights and your time. Everyone also in the audience who's interested to learn more information, also to get connected to our speakers, reach out to us. Majority of you are in the investor circles. For the ones who also wants to join on our website, we have the InvestorCircle form for you to sign up. So stay tuned also for the upcoming sessions. And yeah, thanks again to Julius and Philipp. Thank you for joining us today, and everyone also in the audience.
Thanks so much for having us. And yeah, hope to be in touch soon. And looking forward to seeing you again.
Thank you so much.
Thank you. And everyone have a great week, rest of the week ahead. Thank you.